Hey folks, Dan Frio here with your market update for September 17th, 2024. So looking at it over there, folks, yes, they continue to come down. Could we hit the 5.99 today, maybe tomorrow? Well, let's look at the data that we have coming in next couple of days, because I don't know if you realize, but tomorrow's Fed Day. Not only is the Fed going to come out and tell us what they're going to do, they're also going to provide us with a new dot plot. So if you don't know what that means, I'm going to give you all that information at the end of this video. Well, not at the end of this video, about in the middle of this video. But what I want to go over today is what the economic news is. We have retail sales coming in, and let's get over to Rick Santelli at CNBC. Let him take it away, and then we're going to go over where rates are and then all the other information. So Rick, take it away for us, buddy.
Rick. Yes, we're looking for our August retail sales.
Watch these numbers here, folks, because this is live when he gave us the information on retail sales. Let's see how the equity markets react to this. The S&P 500, the Dow Jones, and the NASDAQ. So pay attention to that as well, and then we'll be right back.
Sales numbers. Now, these are advanced. That means they're going to get modified and fine-tuned in a couple of weeks. The first number we see is up 0.1%. We're expecting a negative number. The reason? Because last month we were up a whopping 1%. That was the best going all the way back to the first quarter of 2021. Now, before I'm done, there may be some revisions, but that was a good number, and we haven't taken any back yet, at least in terms of the new advanced look for August. If you strip out autos, it remains up 0.1. Many were expecting it to be a little loftier than that, but do remember also in the rearview mirror.
Bye, honey.
Whoa, we don't need that ad. Hold on a second, folks.
That's
we have up 0.4 and up 0.5, so these have been rather solid reads. If we strip out autos and gas, it still remains good, up 0.2. One could argue we're expecting a little bit more. In the rearview mirror, once again, up 0.4. Prior to that, it was up 0.8, which was the best going all the way back to January of 23. Then there's what we call the core retail sales, or the control number that gets inputted in other economic statistics higher up the food chain. That remains a very solid up 0.3%. And prior to that, it was up 0.9% in June, and that was the best going all the way back to January 23. Now, there are revisions. Upward revisions. We see last month's get revised from 1% to up 1.1, and we see the core number move from last month's up 0.3 to up 0.4. So we could use the slowing labor market as a reason to ease. The Fed's looking for reasons to ease, but these numbers certainly don't build the case that the consumer is, on the side of the road with nothing left. We see that there's delinquencies. We listen to what Phil said, and interest rates, of course, even coming down a quarter point, even coming down a full point if they do over the next 9-12 months, isn't going to really take some of the pressure off those who need credit, because this two-speed economy still has many who don't need credit. And the Fed, no matter what they do with interest rates, it's very hard to target that group. We see that yields have moved up a little bit, but we're still basically at 15-month low closing yields in a 10-year, 2-year low closing yields going right back to September of 22 in a 2-year. And our last batch of guests really nailed it. The Democratic side of that discussion said, wow, we really have to fix the debt problem. They're currently in office, sir. Why don't they do something about it?
Ouch.
Becky, back to you.
Well, you see what side of the fence that he sits on. So we'll take it from there. So let's get over to the data that he gave us. I don't see this being that robust. Let's go through these numbers real quick. And we're just going to go over retail sales. So you have core retail sales. Last reading was 0.4. That was pretty lofty. Expected to come in at 0.2, came in at 0.1. So much less than was expected. Retail sales, the control group, month over month. Last reading was 0.4, expected to come in at 0.3, came in at 0.3. So here's that number where he keeps saying retail sales month over month. Last reading was 1.1. It was expected to drop all the way to negative 0.2. It came in at positive 0.1. None of these numbers are really saying, wow, the economy is really killing it right now. So let's get over to this section right here. Here's the main news that we have for today. We're going to go to Yahoo Finance, because I'm going to put CNBC at the end, because we want to look at the equity markets going forward. But retail sales top Wall Street's estimates in August. They top Wall Street's estimates in August. No. Oh, maybe the estimates. Okay, my bad. The estimates right through here. I was going to say they're much less than where we were previously. We got that going for us right there. Intel stock falls. A big Fed cut won't spark panic. Well, yesterday a big Fed cut would spark panic. Today it won't spark panic. I don't understand that part. Why a Fed cut may not lower mortgage rates. We went over that yesterday. So this is the mainstream media stuff that you have right through here. Let's go over to here. Now the contemplation is this. How much is the Federal Reserve going to move? But we have one huge piece of information coming in from the Federal Reserve today. Okay, so a lot of people don't understand this or don't know what it is or don't, I forgot it was coming out in tomorrow's meeting. It's called the dot plot. Okay, so we talk every day about, how much is the Fed going to cut? 25, 50, so forth. It doesn't really matter at this meeting because the meeting agenda is there and everything else. But what you have to focus in on is the projections or the forecast of what they give us, because that's what we're basically what we're going off of. Here, let me explain to you guys just briefly on this part of it. Okay, so let's go over to mortgage rates. People keep asking, Dan, when the Fed cuts, how much are rates going to drop, tomorrow when the Fed cuts? Well, what you need to understand is it might not drop at all. Okay, here's why. Let's go to the 30-year fixed, and I'm going to break it down right through here. Okay, so this is what I'm trying to help people understand. When the Federal Reserve comes out tomorrow, the markets might not do anything. The Federal Reserve could even cut rates and rates go up. And here's why. What's happening behind the scenes is mortgage rates are basically tied to a mortgage bond. It's not tied to the 10-year Treasury, which people say it is, and all this other stuff. But what happens is it depends on, I guess, the rumors of what the Federal Reserve is going to do. Okay, so if you see over through there, back last October, which you're seeing through here, mortgage rates hit 8%. Okay, the Federal Reserve really has done nothing from there to here. So why or what caused mortgage rates to go from 8 to 6? Okay, so that's what you need to understand. The Federal Reserve didn't cut rates during this. So what caused it? Well, basically is the markets are correcting itself based on the information the Fed gives us. So it's not only the Fed, it's also all this information that we go over on a daily basis. Okay, so why the dot plot is so important, it gives us projections from the Federal Reserve officials. These are people that sit on the Federal Reserve. They put a dot on where they expect interest rates or the federal funds rate to be over the next couple of years. Okay, so that's why it's so important on that. So we're going to say, okay, I'm still at the proponent that they're only going to cut 25 basis points. If they do 50, kudos. But let's get over to right through here. Here's the CME FedWatch tool. And this is basically created by the Chicago Mercantile Exchange. It helps us figure out, what's the Fed projected to do at the meetings all the way through next year. So here's what this looks like. Okay, it's different than the dot plot. So basically what this is telling us is here's where the federal funds rate would be across the top, and you need to understand how these work. So like, for example, this cell right here, the 500 to 525, that's 5% to 5.25. Okay, the federal funds rate today is in the cell of 5.25 to 5.5. So it'd be a cell over in this section here. It's gone because they're saying they're cutting rates. How much are they going to cut? Well, now there's a 65% chance they're going to cut 0.5%. Okay, but if you look at this, it's basically saying there's a 75% chance by this time next year we're going to be at 2.75 to 3% on the federal funds rate. That's a huge drop. It's 10 cuts from here to there. But what will help us is this. This is what we call the dot plot. Okay, a new one's going to be created today. What you look at through here is right through here. Here's the federal funds rate projections. These are just numbers, and here's the years. Okay, so what happens is each member of the Federal Reserve, when they meet tomorrow, they're going to put a dot on where they expect the federal funds rate to be in 2024, in 2025, and we're going to scrap the rest of this because they don't even know we're going to be at the end of the year. So we'll just stop at 2024 and 2025. So this is telling us right through here, the federal funds rate, the majority of people say the federal funds rate will be between 4.75 and 5%. Okay, right through there. Well, so we go over to the CME FedWatch tool, and that's what we're looking at through this area here. And so basically what you need to understand with this is it's telling us in 2025, the majority of Fed officials are saying the rate is going to be between 4 and 4.25. Okay, so that's a huge drop from where we are now. That's 1.25% in drops that they expect over the next in 2025. A little bit of a contrarian to this, and that's why there's a new dot plot coming out, and maybe there'll be more people putting dots down here. So in 2025, expecting rates to come down even further. So the new dot plot hopefully will sync up with the probability screens, and then we'll get a better read on what the Federal Reserve is going to do. I hope you guys understand that part of it. Okay, so here's right here, next Fed Reserve meeting, why it's so important. It's right down through here. They're creating a new dot plot right through here. The new economic projections released once per quarter includes the dot plots. It's going to give us where the excess policy makers expect rates to be in the next couple years. So that's what we're seeing right through there. Let's get over to the equity markets and see how they're trading right now. I went in this right before the retail sales came out. Basically, every indice up there was zero. It was basically unchanged. I'm like, that's crazy. But let's go through it. The equity markets are basically poised for a good day today. We have the Dow Jones up another 150 points. The S&P up 31. We have the NASDAQ coming back, roaring back at 130, up 100 Thursday. Russell is up. The VIX, which is the anxiety of Wall Street, is down. So this is telling us traders are pretty comfortable today. Let's see how the cryptocurrency market's doing right now. It's teetering on that 60 grand again. So, and then let's check in oil. Oil is up just a tad. As long as this is staying right around 70 bucks, we're good in that sphere. So let's get over to see what the bond market is telling us for today, what the Federal or what the mortgage rates are going to do. So here's what I need you to understand. What creates mortgage rates? This bond. Okay, this bond, it says MBS right up there. It says 30-year UMBS. This is a mortgage-backed security that trades on Wall Street. It's a yield. It's a bond that trades on Wall Street. Let me show you how this works. And I usually do this kind of once a month. Okay, this is the price of the bond. Okay, I'm going to show you how bonds work. Okay, especially how the price and the yield works. Okay, so when the price of a bond goes up, we love when it's going up because the yields are coming down. So when the price goes down, rates are going up. Let me explain it to you. So let's say, for example, you're buying a mortgage-backed security bond that matures next year. Okay, most bonds have a maturity value of $100. Okay, so let's just assume that. So let's say it this way. I'm going to give you a low price right now, and then I'll give you a higher price, and I'll show you how the yield drops off considerably. Okay, so let's say today I give you a 50 bucks. Okay, I'm going to give you 50 bucks for that $100 bond. Okay, so I give you $50, you give me my bond. Okay, I'm sitting on this bond. It matures next year, remember? So we sit back and we wait till next year. Next year, I give you my bond and you give me my $100 in return because that's the face value of the bond. Okay, so I gave you 50 and I got $100 back. What's my return? I doubled my money. So my yield is 100%. Okay, so let's drive up the price so I can show you how driving up the price reduces the yield. So to make it as simple as I can, let's say today I give you $100, you give me my bond, and we sit back and wait till next year. I give you my bond and you give me $100. Well, it's face value. You give me that back. So I gave you $100 and you give me $100 back. My yield is zero. So do you see how when I give you 50 bucks, change it from 50 to 100, I give you more money, the yield just basically disintegrated. So that's how this works. So we love when the price of the bond's going up. Today we have it down just a hair. 7 ticks isn't really going to do much of anything. It might add in, let's go back to the rate sheets that we have, or the rates, today's rates. So we might pick up, this might be at 6.15 based on this data that we have so far today. So that's it right now. All the news is in for today. All the news is in for the Fed. So we're just going to wait for tomorrow to see what the Fed does. Especially, we're going to check out that dot plot. So stay tuned for that. I will be back later today with the closing bell. But if you guys have any questions when it comes to buying that first house, maybe buying your first investment property, we have a ton of people reaching out to us to refinance, believe it or refinance. So we're going to start creating a tab up through here where if you wanted us to track your rates for you, we're going to have you put in your information up in one of these tabs. It'll be like, refinance, alerts or calendar or whatever. And you'll be able to put in your data, your homeowner information and all this with the rates, and then tell us what rate you want or you're looking for. And when that rate hits that, we're going to be right on the phone with you guys so you can capture that rate and save some money. So if you want to learn more about me and my team, just visit us at the Rate Update. My name is Dan Frio. I'm a loan officer licensed in all 50 states as well as Puerto Rico. So if you're out there and you're needing help with a mortgage, any kind of mortgage, as long as it's on residential property, I would love to help you. So check it out at therateupdate.com. If you're looking to buy that first house, please check out the grant finder right up there. It's hand-picked grants that we've chosen because there's really not much ramifications to you guys. It's almost virtually free money to you when you're buying that house. So if you're looking to put in your application, just hit the Apply Now button, or you can scroll down right through here and give us a call. You can call us at 844-775-5626, or you can email me directly, yes, it's me, at dan@therateupdate.com. So thanks so much for watching, guys. God bless. Have a fantastic afternoon. I'll be back here at the closing bell to let you guys know how all this wrapped up for the day. Thanks for watching. See you then. Bye-bye.